Yeah. So we have the semi-strong form of efficient market hypothesis. So whenever we talk about this particular form of hypothesis, generally we carry out two types of tests. One is your, what in general we call it the residual analysis. And another one is, we call it the event studies. So these are the two different approaches we use for testing the semi-strong form of efficient market hypothesis, to test the semi-strong form of EMH. So what do you mean by this residual analysis? The residual analysis is basically what? It talks about, what do you mean by the residual here? The residual here means we are trying to find out how much actual return we got from the investment and how much was the expected return. Okay. Already I told you that your expected return can be calculated as using your CAPM. Your expected return is basically already calculated. Your alpha plus simple model characteristics equation I'm writing, alpha plus beta into Rm, for example. So I will give you one equation already which is estimated using a data. Let your line for calculation of expected return for a stock for a particular period, different periods. I will write this is 1.33. 1.33% I can write plus 1.1 into Rm. Your beta is equal to 1.1 and your alpha is equal to 1.33. This is the equation which is given to you. And then what basically we are trying to do, I'll give you the different periods. It is the monthly data, the different months, assume. Then I'll give you the actual return percentage. Then your expected return. Then you have we call it the abnormal return, which is the residuals. So month 1, your actual return is 14.75. And you have to calculate your expected return. And to calculate the expected return, we need market return. We need the market return. So here I am giving you also the market return. Market return is 12.15. Right? Then what is your expected return? Your expected return is 1.33 plus 1.1 into 12.15. Right? Then it will be coming. Kitna aa raha hai? 14.70. Am I right? Is it correct?
Yes, sir.
Into 12.15 plus 1.33. Around 14.695, then 14.70, right? Yes?
Yes.
Okay. So your expected return has become 14.7. Then what is the abnormal return? The abnormal return is basically your abnormal return formula will be your actual return minus your expected return. So your actual return was 14.75. Your expected return was 14.7. Then your abnormal return will be 0.05. Right? Let for the second period, your actual return you got 14.4. Market return was 11.95. And you got, obviously using this, you can get your expected return, that is let 14.48. Then your abnormal return has become 0.08. Your abnormal return has become minus 0.08. Like that in the third period, let it was 14.82, let it is 12.2 market return. Then your expected return was let has become 14.75, and your abnormal return has become 0.07. Fourth period, let it is 15.01, market return is 12.35. Then your expected return is let become 14.92, then it is 0.09. Fifth, it is 14.92, 12.3, then it is become 14.86, then it is become 0.06. Then in the sixth, it is 14.68 actual return. Market return was 12.2. Let it has become 14.75. Then it is become minus 0.07. Seventh period, that actual return has become 14.38. It is 11.95. Then it is become 14.48 and minus 0.110. So once you calculate this, then what basically you can do, you can take the summation of the sum of all those abnormal returns. Somewhere it is negative, in 3 places it is negative, in some places it is positive. So if you take a summation, then maybe it will come 0.02. So if you observe from this particular example, whatever basically I have shown you, from this example, if you observe that the sum of the abnormal returns are close to more or less 2%. Sorry, 0.02%. These are all percentage data, 0.02%. So the 0.02% is almost approximately equal to 0. That is the assumption we can assume. In this case, it may be close to 0. So that means this particular abnormal return, summation of abnormal return is not very high. So in that case, we can say that the market is semi-strongly efficient. What does it mean? It means that the price or the return is reflecting all those kind of publicly available information to that. By that, and all those information which are coming in a random fashion to the market, and that is reflected through that particular prices. So over the time, somewhere you may get more return than the expected, somewhere you may get less return than the expected. By that, some adjustment is taking place across the particular time, and the sum of the total abnormal returns, what basically you are going to get from this, that will be basically close to 0. So that is what basically what we can conclude from this. The residual analysis basically tells you that this particular abnormal return is close to 0. So because of that, we can conclude that the market is semi-strongly efficient. Then there are other approaches in this particular context. Another method is basically your event study method. So what you mean by this event study? The event means any event which has occurred in the company. So we have to see that in and around the events, how this abnormal return basically we are getting from that particular companies. I will give you 4 companies. I'll give you 4 companies and I'll give you the equation for the 4 companies. For example, the expected return for company 1 will be calculated as 1.70% plus 1.05 RM. For company 2, you can calculate their expected return 1.53% plus 1.08 RM. For company 3, let it is 1.92% plus 1.02 RM. For company 4, we can write it is 1.42% plus 1.09 RM. These are given to you. There are 4 companies, and they have increased their dividend. The event was they have increased their cash dividends. They have increased their cash dividends. Let for the year 2020. So, as an analyst, you wanted to test the consistency of the semi-strong form of market efficiency. So, you have calculated the characteristics line equations. These are called the characteristics line equations, and to calculate your expected return. Okay. So, there are 4 companies and there are 4 characteristics line equations which has been given to you. So, first basically what you have to do, you have to define the period. Generally what we do, we have to basically, your data period is frequency is monthly. So, we take the divisions of the period like this, 0, when the dividend was announced, that is the 0th period. And we also take the periods after 1 month, after 2 months, after 3 months, after 4 months. Then before 1 month, before 2 months, before 3 months, before 4 months. This is the announcement month. This is the announcement month, which is the 0th month. Then we have to consider this analysis to divide it into 2 parts. One is before 1, before 2, before 3, before 4, and after 1, after 2, after 3, after 4. And I will give you the actual returns of the different companies. Actual return, you need the market return. From there, you can calculate your expected return. Then you can find out your abnormal return. Right? So, the actual return data is available to you in the different period. Market return data is available to you in the different period. Expected return is available from there, from this equation. Let you are calculating for the company 1. This is for company 1. Then use this equation to calculate the expected return. Then your actual return minus expected return, that will give you the abnormal return. Is it clear? Yes or no? Hello?
Yes, sir.
क्यों people are not asking anything? चुपचाप बैठे हो, क्या हुआ? रियांसा?
Yes, sir.
क्या हुआ? समझ में आ रहा है ना? Why actually so silent today, you people? Any? Or you are not in a mood to study today?
Sir, I think most of the people have tests from today.
Which test? Test is started today. Already test is started.
Sir, I mean test for other subjects. Yes, sir,
Is
today
there any
from
other
today.
test today for you?
No, sir, not for me.
Okay,
But
so that's the
for most of the other people.
okay. So that is the reason.
Yes, sir, I think so.
Okay, but are you getting it? What actually I am discussing?
Yes, sir.
Okay. It is applicable to all of you. Sagar?
Yes, sir. Yes, sir.
Okay. So there are how many? Three Sagars. Sagar Kumar, Sagar Suman, Sneha.
Yes, sir.
It is clear or not?
Yes, sir, it's clear.
Okay. So the event is the dividend announcement. So in this period, the dividend was announced. So we have to collect the data for the actual return for the particular company at the announcement of the dividend date or dividend month, as well as before 4 months and after 4 months. Then we have the market data. Then accordingly, we can calculate the expected return, then the abnormal return. Let the abnormal return we have calculated. Let I am writing it. The abnormal return for company 1, that ABC, this SC1, abnormal return ARC company 1, like your ARC4, then ARC3, then ARC2, then ARC1, then your ARC0, then I can write ARC -1, -2, -3, -4. We have the abnormal return for company 1 for this particular in and around this announcement of that particular event. So like that, we can also calculate this abnormal return for the company 2 in the same way using this equation. We can also calculate this abnormal return for company 3. We can also calculate the abnormal return for the company 4. Right? So once you have calculated the abnormal return for the different companies in the different periods, let for company 2, we can write that ARC abnormal return of let it is C14, C13, C12, we can write 10, 11, 12, 13, 14. I can write it as ARC 24, ARC 23, ARC 22, ARC 21, and so on and like that. So then what basically you can do for all companies whenever we calculate, then for each period, you calculate the average abnormal returns. That means for this period, this is one period. This is one period. For all companies, let I can write the average return we have to find out the ARC14 plus your ARC24 plus your ARC34 plus your ARC44. If this is for company number 3, this is for company number 4 for this period divided by 4. Right? So this is basically what we can get. For this period, average abnormal returns we can calculate. AR4, just for example, we can write. So like that, you can calculate the average abnormal return for the period number 3, for period number 2, for period number 1, for period number 0. Then before that, -1, -2, -3, -4. So now what basically you have total periods are basically 9. 1, 2, 3, 4, 1, 2, 3, 4, and 1 is 0. So then what basically you can calculate, once this average abnormal return for each period will be calculated, then what basically you can do, you basically calculate the cumulative average return. You have to calculate the cumulative average abnormal returns. CAR. That means whatever returns you are calculating for each period, this like AAR 4 plus AAR 3 plus AAR 2 plus your AAR 1 plus your AAR 0, then your AAR -1 plus your AAR -2 plus your AAR -3 plus your AAR -4. You take a summation of the excess returns or abnormal returns that you get in the different periods, then check whether this, what is that value is coming. If let that value is X, so if the X is very much close to 0, the cumulative average abnormal returns, if that is, this particular value is very much close to 0, then we can say that the market is semi-strongly efficient, unless not. The market is semi-strongly efficient, unless not. So like your residual analysis, here also we have checked that the abnormal returns for a particular company over the period should be close to 0. Here we have considered one event. So we consider that event which is basically announced by the company, that information is publicly available. So if that is publicly available on a particular date 0, after that the company, the return will behave differently, and before that particular event the company's return was behaving differently. So somewhere the company has got more return, somewhere the company has got less return. The event is positive, event is negative, or event, the implication of the event is something different on the basis of the knowledge or the idea about that particular event by the different market participants, how they have considered these things. So accordingly, they can say that whether this particular event has any impact on the price and the return of this particular asset, and accordingly we can conclude that whether in and around that particular event the cumulative average abnormal return is close to 0 or not. So then we can conclude if it is close to 0, then market is semi-strongly efficient. If it is not close to 0 or it is relatively high, then we can say that the market is inefficient. This is basically the another way we can always test the semi-strong form of efficient market hypothesis. Okay, but the question here is that in true sense, if you see that there are many ways the market is behaving in a different way. The market's reaction towards the different kind of factors are different. Basically, these particular studies questioned whether some kind of regularities in the rate of return during a particular year or during a particular week is prevailed in the market, which basically allow to predict the returns for a particular stock. That means a particular trend is followed, or a particular kind of pattern is followed for a particular kind of stock or particular kind of market. So because of that, it is sometimes compel the investors or compel the market participants to react accordingly or to act accordingly. So in that case, we can say that the market is not that way efficient. So some of the examples you might have heard already, but I'm just sharing with you. Have you heard about the January anomaly? Yes. These are called anomalies, or in general we call it the calendar anomalies. Have you heard about January anomaly? Hello. Yeah.
Sir, it is argued that stock prices rise in the month of January the most.
What you said? The price will?
Sir, it is argued that the stock prices rise the most in January.
The price is high in the January.
Sir, the stock prices.
Stock prices. Why? Price is
Sir, it has
high.
been observed.
Price is high in comparison to the previous period. That's what you are telling?
No, sir. Like in a year, the prices are most high in the month of January.
Hmm.
Like I might be wrong, but in a complete year, the prices are most high in the month of January.
The price is high in the month of January in comparison to the price of the month of November.
The price in the whole year.
Price in the whole year. Not necessarily whole year. The price of, it is not whole year. The price of the particular stock is higher in the month of January in comparison to the price in the month of November and December. Okay, previous months. It is not for the whole year. But do you know that what is the reason?
Sir, maybe they get some tax benefit, short-term capital and tax.
Yeah. Does it happen in India? Does it happen in India?
Might happen.
But in India, it does not happen. The India basically our tax period is not January.
It might happen during our result area.
For India case, if you say that it may be April anomaly, right? You can say April anomaly. You cannot say January anomaly. January anomaly is more popular because that consistently prevailed in US market. Generally, what happens that many investors, including even institutional investors, tend to engage the tax selling towards the end of year to establish a loss in the stocks. That's why there are more selling pressure on the stocks. They try to sell the stocks and they want to show the losses in their balance sheet. So in that case, whenever there is a selling pressure on the stock, the price basically relatively goes down. And again, they immediately buy back that particular stocks or buy those kind of shares in the early January, first week of the January itself. So because of this, once there is a buying pressure again put on that particular stock, the price basically goes up. So that's why in comparison to the month of November and December, the price of the stocks in month of January is relatively higher. So that basically we call it the January effect. Okay. So there are other kind of effects also happens. Other kind of calendar anomalies exist in the market. Okay. You know about weekend effect? Yes. What is
No,
weekend?
sir.
Don't know? Weekend effect means?
The stock prices on Monday are low.
The mean returns of Monday was negative. Okay. Or lower. That is what you are telling.
Yes, sir.
Okay. So the Monday effect, if I say that Monday effect, what do you mean by the Monday effect? The Monday effect is basically if you compare the price from Friday closing price, Friday closing price to Monday closing price. Okay. So the Monday effect is decomposed into two parts. The Monday effect is typically measured from Friday closing price to Monday closing price. That has been divided into two parts. One is your weekend effect. One is your weekend effect, and the other one is the Monday trading effect. Monday trading effect. You see, whenever you are comparing the price of the Friday closing to Monday closing, we are trying to measure the Monday effect. But Monday effect is decomposed into two parts. One is your weekend effect, other one is the Monday trading effect. So what do you mean by this weekend effect? The weekend effect is basically what? Friday closing to Monday open. Friday closing price to Monday open price. And Monday trading effect is basically what? The Monday open to Monday close. Monday close. So the negative Monday effect basically actually occurs from the Friday close to Monday open. The negative effect is reflected from Friday closing to the Monday open. Actually, this is called weekend effect. Okay. And this part on the day of Monday, the pure Monday trading effect is always positive. They are always positive. So that's why the Monday weekend effect may be negative. So Friday closing price, if you compare the Friday closing price to Monday opening, whenever the market opens on Monday, relatively the price will be lesser than the price of the Friday closing price. But whenever you compare the Monday opening price to the Monday closing price, you find that the price trend is positive. There is a positive effect which is working there. So therefore, the whole Monday effect has been decomposed into two parts. One is your weekend effect, other one is basically called the Monday trading effect. So generally the weekend effect is negative, but the Monday trading effect is many times it is positive. Okay. But this effect also vary across these different kind of other characteristics. Okay. Monday effect and this kind of weekend effect and all these things what we talk about, the previous studies basically have shown that the Monday effect was on an average positive in January and negative for other months. The Monday effect is basically on an average positive in the month of January and negative for all the months, particularly in the country like USA. Okay. It is just different than the other months because Monday effect is negative, that we know, and that negative effect is reflected through the weekend effect, which is comparing the price between Friday closing to the Monday opening. But in the month of January, it has been observed that the Monday effect is positive. Okay. If you go for a large farm, the negative Monday effect occurred before the market opened. Basically, it is the weekend effect. Whereas for the smaller farms, most of the negative Monday effect occurred during the day on the Monday, which is the Monday trading effect. So the negative Monday effect for the large farms is due to the weekend effect, and the negative Monday effect for the small firms is due to the Monday trading effect. So that is the basically the observations what basically we got whenever we talk about the or we analyze the previous data. Okay, then we have the what we can say the strong form of efficient market hypothesis. So this strong form of efficient market hypothesis, if you see, so that is basically studied in the different way. Basically, what we said that no group of the investors should get more return. No group of the investors should get more return. That means the stock prices should fully reflect all the information, both public and private, which implies that no group of investors have access to private information that will allow them to consistently earn above average profits. That is what basically what we can test from this. So how we can test it? So to test this, we generally divide the different investors, a different type of market participants. How we divide it? One division, one group is we call it the corporate insiders, like the insiders which are there in the major corporate who are the major corporate officers, directors, or the owners who have the 10% or more equity shares. We can call them the corporate insiders. Another group we call them the stock exchange specialists. The specialists have some kind of monopolistic access to the information. Some access they have because of the connection and because of certain kind of networking, or maybe because of certain kind of expertise. They have the some kind of access. Then we have the security analyst. The security analyst also, they have the existence of superior analysts who possess some private information. And there are some professional money managers who are working full time as the investment in investment management activities. So these are the different groups. And obviously we have the retail investors group. So then what we can do, we see that over the time, how consistently one particular group is dominating the other group or overperform. Their portfolios are overperforming the other group. Their portfolios are overperforming or giving more return than the other group. So if you find consistently the one group of the investors or one group is getting more return or performance, their performance is always much more higher than the other groups, then we can say that the market is inefficient. But if you find that there is no such return differences exist across the different groups, then we can say that the market is strongly efficient. But in a true sense, if you observe that the studies basically don't support the context of the strong form of efficient market hypothesis, because obviously there are some groups like corporate insiders and the stock exchange specialists. They have certain kind of monopolistic access, and which basically help them to get more returns in the market. So that's why the market is not basically strongly efficient. And after that, obviously there are other factors also which are basically showing that the market is not efficient. Like consistently, if you see, the small size companies are performing better than the large size companies. So that's why people consider size is a major efficient market anomaly. You like the companies having the lower market to book ratio, they are performing better than the higher market to book ratio. companies are having lower price earning ratio have the major opportunity to grow in the future, or they are performing their expected return is more than the high price earning ratio companies. So there are different other ways people have constructed their portfolio on the basis of the different characteristics, and they find that there is some kind of trend, some kind of we can say that strategy we can formulate to get more return from the market, which is basically is not in favor of the concept of the market efficiency, because market efficiency always feels that always there is the prices behave randomly, and the news or the particular event which has the impact on the prices, that also come to the market in a random fashion. Because of that, the prediction or any kind of strategy what you are going to formulate for that kind of investment process, that is not going to help to any group of the individuals or any group of the investors to get more return from the market. So that's why that is the actual concept of the efficient market. But in a true sense, to some extent, there is some degree of inefficiency exists in the market, and that inefficiency sometimes also helping some group of the investors in the market to get more return. So this is what about the concept of the market efficiency. Then we